Hi, do you know what is interest rate?
Yeah, of course, as an econs and finance student, I do know.
It's like your borrowing cost.
Wait ah. Interest rate.
OK 啊，讲啊，
你讲啊，你讲，我不是我会讲。
Something that I pay out and then I need to repay it.
Interest rate is a percentage.
Struggling to keep up? Welcome to the FOMO Fix. When the Fed changes interest rates, most people will ask, what should I buy now? But the real question is, what stories are interest rate changes telling us right now? So today, we're going to unpack the full interest rate cycle so that you will understand how it shapes the economy, your money, as well as your investments. And welcome back to the FOMO Fix. I'm Hazelle from the Joyful Investors, your navigator on this journey to financial empowerment. And joining me today, we have invited James and Anshul. Hi guys!
Hi everyone, I'm James. I am a SGS Academy trainer. I am the market strategist at Tiger Brokers Singapore as well. So I have been in this financial industry since 2007. What I do day to day is I write a lot of research articles. I provide market commentaries to the media outlets, and I conduct a lot of webinars and seminars as well.
Hi there, I'm Anshul, and I'm a year 2 applied computing fintech student, and I'm a retail investor for 4 years.
Alright, so for someone who just started investing, right, with all the recent news about interest rates, whether it's rate cut, rate hike, I think it's going to be pretty complex and confusing for them. So maybe James, you can first help us to break down what exactly are interest rates, why does the Fed changes them? Let's talk about this briefly first. Later on, then we dive deeper into the full interest rate cycle.
So interest rate is basically the cost of borrowing money. If you go to a bank and take out a housing loan, you are basically borrowing money from the bank, so you need to pay interest to the bank. If you are saving money in a bank in the form of fixed deposit, the bank is literally borrowing money from you, so the bank need to pay you interest. Why Federal Reserve changes interest rate? Federal Reserve changes interest rate to maintain price stability and maintain a healthy labor market.
Okay.
So for example, if the inflation is too hot, Federal Reserve needs to increase the cost of borrowing by increasing the interest rate to discourage people spending in order to cool down the inflation rate. And if the labor market is too weak, like what we see in the US at the moment, then the Federal Reserve needs to bring down the interest rate to encourage business spending, hiring, to boost the labor market and to boost the economic growth.
Okay, so in other words, to really control the level of economic activity, right?
Yes.
And they have two very important objectives that you mentioned. One is for stability of prices.
Yes.
Another one is for maximum employment as well in the market. So for Anshu, you have been investing actively, right?
Yes, that's right.
So when you see all this news about interest rates, right, do they actually bother you, or do you feel that they impact you in any way?
Yeah, definitely. When I do see these news, then I'll be like, okay, so what's going to happen to the portfolio that I'm actually having? And then I think that recently the US dropped about 25 basis points, and due to that, I do see the market being very green lately, and then improve my portfolio in the short term. Yeah.
Ah, okay. And the reason why I asked you this question is because we actually asked the exact same question in a poll to our audience as well. So the question was, does the Fed's interest rate changes affect you? And here are the results. 53% of them said yes, it affects them through their investments. And then 19% said yes through their loans and mortgages, while 16% said no, they don't feel any impact. And finally, the last 13% said they were quite unsure about the impact of this interest rate changes. So James, what do you make of these answers? And for the 16% and the 13% who said no, they don't feel the impact, they are unsure, are they missing something here?
I would say that they are underestimating the impact of the interest rate cut.
Okay.
And I would say that they probably are taking up a fixed rate housing loan or they cannot really associate the interest rate movement with the stock market.
I see, right. So when the interest rate changes, right, the markets may sometimes swing wildly. There could be more volatility. So I think we definitely need to dive deeper into looking at the full interest rate cycle. But before then, let's play a very quick draft pick game. So Imagine that rates are expected to continue to come down further in the next upcoming months.
Yep.
And if you could only choose one thing in your portfolio, which one would it be? Number one, tech stocks. Number two, REITs. And the third, bonds. Only one choice. Cannot choose more than one. So maybe let's hear for Anshul first. What
Well,
would
I
you
think
pick?
Hazel, that's a very tough pick, right? So I think I'll go with the tech stock.
Okay.
Knowing that the rates are dropping and the present value for the future prices that's gonna come
Okay.
will be way better for the outlook of the industry. And that's why I think I would choose the tech stocks, especially when the interest rates are lower. The companies would tend to either expand or buy or have a share purchase back. So that being said, the companies will eventually grow at a cheaper rate, and that's why this will affect the dividend for the different offerings from the companies, or maybe I would say the stock prices will generally increase for a short 6 to 12 months.
Okay, so tech stocks.
Definitely.
Okay, what about James?
I will pick REITs 100%
Oh.
of the time.
Oh, 100%.
Of
Wow,
the
that's-
I mean,
confidence.
100% of the time if interest rate is coming down.
Okay.
Because I think this is why the REITs counters have been doing quite well so far this
Yeah.
year, based on the rate cut expectation as well. I would say that they are the largest rate cut beneficiary.
okay.
I continue to see larger than expected and sooner than expected rate cut going forward. I do not pick tech stocks.
Okay.
Because to me, a good technology company should do well with or without the rate cut.
Correct.
Okay.
And I do not pick bond because, rate cut means falling bond yield. Then it will attract lesser bond investor to own them.
I see. Okay. And for myself, actually, I think it's very difficult also because myself personally, I do invest in both tech stocks and REITs in my own personal portfolio. Maybe not so much of bonds, but yeah, so it's quite tough. But if I were to pick one, actually, I would still pick tech stocks as well. But
Okay.
the reason is also just like what James actually. It is not because the rate cuts are coming. That's why I pick tech stocks, but more so that. Firstly, I mean, at this stage of life, I would want to prioritize more on the capital growth. So that's why the tech stocks. But the reason why I like to invest in tech stocks is not just because the rate cuts are coming, but rather they are businesses that are very relevant in our everyday lives. So some of those companies, I use their products, I use their services myself. Some of them,
Yes.
maybe I don't use them, but I do see the corporates using them because
Right.
those are their customers. So if they are relevant, they'll be here to stay for the next 5, 10, or even beyond that in our society, right? So these are the companies where they have very good cash cow. Yeah. So
Yep.
and with all the technological advancements, AI, those are potential growth drivers. So for me, actually, I'm not a very macro person. I'm a more fundamental at a company specific level. So I want to pick those companies. But I do invest in REITs as well. So I think it's really a tough choice. And I have actually taken a position of REITs in the last few years because of that period where they are at very low valuations. Right. So, but indeed, I guess the conclusion to this question is we cannot just have one type, right? In our portfolio. We probably have a few types of stocks or a few types of investments, maybe not just stocks, you have bonds and so on in the portfolio so that you are more diversified. Okay, so with that, let's now move further into that interest rate cycle. So James, which part of the cycle are we at right now?
Okay, speaking of interest rate, I think we are still in the beginning of a rate cut cycle itself.
Okay.
And as we all know, we have seen one rate cut in September
Yes.
from the Federal Reserve, and according to CME FedWatch, we should see 2 more rate cuts by end of this year and another 2 rate cuts in 2026. So we will be seeing 4 rate cuts by 2026, and I think that they are still underestimating the number of rate cuts.
Okay.
So this is why I would say that going forward, if there is more rate cut, it should boost the economy and should boost the equity market. The reason why I say that investors have been underestimating the number of rate cuts is mainly because I would say that I don't see hotter than expected inflation going forward because number one, AI evolution should have some disinflationary impact, and number 2, I would say that the US labor market is still weakening.
So you're saying that 4 major cuts that's coming up all the way until 2026, right? So do you think retail investors should make the right choice and enter into the long position in the tech stock market?
Yes, I would say that we are in the midst of the AI bull run itself. So this is almost as huge as the year 2000 dot-com bubble.
Correct.
Yeah, so this is why I am quite constructive on the AI beneficiaries, and this is why you should have some technology stocks in your portfolio. Yep.
So, since you talk about that, you believe that we are still at the early stage of the rate cut, right?
Yep.
So, other than REITs, which you talked about earlier on, so any other types of industry sectors you think are poised to benefit from the rate cut?
Rate cut will benefit high growth technology stocks
Okay.
and will benefit small mid cap companies as well.
Okay.
But overall, rate cut should improve investor sentiment towards risk on asset. So we should continue to see widening market breadth, meaning more people are investing in all sort of equities, not just only the REIT sectors. So rate cuts should also bring down the discount rate in the discounted cash flow model,
Yes.
improve the present value of future earnings.
Yeah.
So this is why all the stock target price should also improve.
Correct. And it's also about a choice, right, of what kind of investments. So in the last few years, a lot of people have been putting the money in the T-bills, in those fixed D, because the interest rate was higher. So those instruments were able to give higher returns for them naturally. But now that the rates have already come down, right? So for those investments in your T-bills and your fixed deposits, they are no longer going to give you as attractive interest rates anymore. So that's why the money has to flow to somewhere else, right? And that's where the risk assets like the equities could then be more attractive, like what James you mentioned earlier.
Yes. So speaking of the money coming out from the T-bills itself, right? I would say that one of the key beneficiaries will also be those high dividend paying companies as well. Because
Okay.
if you are constantly getting some yield from the bond, and then if they do not offer you the same yield anymore, then you want to park your money in something that can give you some higher coupon yield, higher dividend. So it would definitely benefit the high dividend paying companies.
Yeah, and if let's say the economy still remains resilient, let's say we don't go into a recession, and then with the rate cuts, that will also free up more money. And some of the companies in the consumer discretionary, they might also be able to do better if people have more purchasing power with a lower interest rates, and if let's say the economy is still doing well. But of course, if the economy activity weakens, then that's another story that we have to look at again, right?
Yes.
So we talk about rate cuts. Now we know that after rate cuts, the next part of the cycle is the rate hikes, right? But in between, maybe you can help us to complete the link. How does it move from a rate cut and then all the way to a rate hike?
Based on the economic cycle itself, if you lower the rate low enough, then definitely it will spur the corporate earnings and spur the economic growth. And sooner or later, you will see more purchasing power, and people purchase more, then you will bring in more inflations. And hence, you need the Federal Reserve to step in to raise the interest rate to cool down the inflation itself.
So it's really a cycle, right? When it's at one extreme end and then you do something, right, and it will push us the economy to another extreme end. And that's where the Fed has to come in to raise the interest rates.
Yes. So the Fed wants a Goldilocks economy, so they do not want a too hot or too cold economy and inflation as well. So this is why they always want to step in to help the economy and help the inflation. Yeah.
So during a period where we have the interest rate hike, what are the industries, sectors, once again, that may benefit during a rate hike?
This is tough questions, but I would like to say banks will benefit.
Okay.
So banking stock will benefit because of the NIM expansion story, the net interest margin expansion story. Maybe consumer stable utilities sectors will benefit because they are less sensitive to the economic cycle, and they should still provide constant cash flow and dividend.
So
And
more defensive.
yes, and probably bond will benefit as well because you will see a higher yield environment, so bond will giving out more bond yield and it will attract more bond investor to own them. Yeah.
So essentially, after hearing about this full interest rate cycle,
Yep.
it's really like a seasons, right?
Correct.
You go through one whole cycle. So for Anshul yourself, when you are managing your own investment portfolio, did all these changes in interest rate affect how you actually manage your portfolio? Do you do anything to shift things around?
Right, I think essentially all of us will have to diversify our portfolio, right? And then with this news up and coming, we will need to know where we can free up our resources to actually ensure that we are always in the green. So if you're gonna say that it's gonna have a interest rate hike, then I would need to know where can I actually lessen my resources and then invest in maybe the T-bills and the bonds market, because they would indeed be providing higher yield as compared to the current situation at the moment. Yeah.
Okay, so James, maybe for the young investors or even new investors who are tuning into this discussion today, right? Share with us what are 3 actions that they can actually take to manage a portfolio under this kind of environment where we have changing interest rates. How can they actually manage and build up their investment portfolio?
Oh, okay. So first of all, I believe that investors need to understand that Federal Reserve is cutting the interest rate to prevent a recession, or cutting the interest rate to save the economy from a recession. So this is why Federal Reserve is trying to help us all. So number one, if you see that the economy is still strong, you need to ask yourself whether you have gained enough exposure in the equity market. If you have not gained enough exposure, probably you should want to invest more in the equity market.
Okay.
Because whenever the interest rate cuts, you should see investor favor more risk on asset. Number 2 is that I believe all investors should learn how to buy high and sell even higher, because most of the stocks nowadays are trading near the all-time high or at the all-time high.
Yes.
So you need to really convince yourself they are still worthy of your money to
Definitely.
invest. So the thing is that as long as you can pull out all sort of valuation models and to justify that they deserve a higher fair value, so the current price that they are trading now is still considered inexpensive.
Okay.
Yes.
Yep.
And probably I would say that the third thing is you should stay invested at all times.
Okay.
Time in the market is more important than timing the market itself. If you have some money, park it on the sideline. It's tough for all of us to beat the market.
I see.
Yes.
Okay, so these are the 3 actions that
Yeah.
young investors can consider about.
Yes.
Right? So obviously in this journey, I mean, we know what we need to do, but sometimes it's unavoidable. We might still make some mistakes along the way, right? So let's talk about some of the common mistakes as well. Maybe Anshul, do you have any one biggest mistake that you want to share with us? Whether is it based on your past
Right.
experience, or whether it's from your friends, what you have seen happening to them when it comes to managing their portfolio during this kind of very varied environment and macro changes.
I think what I see or what I've seen with my friends is that news or this information scares them, and with this being in place in social media as well, right? They would tend to, okay, never mind, I'll leave it in the bank, which doesn't help them in the long term. And then
Lose
when
to inflation.
yes, that's the scary part, right? So you actually believe what's being shown on social media and be like, okay, let's not do anything. Let's just sit tight at the moment. Yeah. So that's why I think that one of the mistakes would be to never, not say never leave it in the bank, but learn to hedge against inflation. So yeah,
How to let your money grow and work harder for you. Okay.
that's the right term you would say. Yes.
Okay, yeah. So, yeah, I mean, it's true, right? A lot of people think
Yes.
that investing is risky. But
Correct.
actually, if you leave it in the bank, it might be even riskier.
Riskier.
But they don't realize it lah, because
Yeah.
you don't really see it reducing in value, right?
Correct.
But actually, the purchasing power it is eroding over the years because of inflation, right? And how about for James? Maybe you can share with us what is a top mistake that you want to talk about and share with our audience as well, so they can learn from this.
I would say number 1 would be catching the falling knife.
Okay.
So I would say that a lot of investors have been trained to buy low and sell higher.
Okay.
But whenever you try to buy something at a lower price, right, maybe you are catching the falling knife, or maybe you are actually buying the losers instead of buying
Okay.
the winners themselves. So I would say that you need to start to look at it at a different picture. Maybe the price are falling down because they are not a good company to begin with.
Yes.
And number two, I feel that a lot of investors has been taking small profits. Okay, there is a saying, that you can never be wrong if you take profit. But to me, you can never get rich if you constantly taking small profit. So
Okay.
this is why we always need to wait for the big moment to take the big profit instead of constantly taking small profit. Unless you tell me that you are a trader,
Right.
so you'll
Okay.
be taking small profit all the way. But if you are a
Correct.
long-term investor, you really need to stay on
Right.
on your investment journey.
Okay.
Yeah.
So in other words, if I could add on is like, all the different kind of investing styles and methodology, right? I mean, it's not just blindly following them.
Mm-hmm.
So like what James you talk about, catching the falling knives. But if the company itself is not even, the fundamentals aren't even great anymore, then why are you still buying them just because the price is getting cheaper, right?
Yes.
So there still must be some investment merit, which means to say the company must still be good. And it could be a temporary mispricing, then you can take on the opportunity. But otherwise, if it's a lousy business, lousy fundamentals, then there is no point in investing in it, because that's going to increase your investment risk in this. So you're not doing yourself any favor lah. So
Yes.
in that aspect, for myself, I think one very common mistake is also chasing after whatever is hot, because people look at social media, people look at the news, so whatever is trending, whatever is hot right now, they tend to just chase after that. Yeah, but I mean, in the stock market, we see that they move up, they move down as well. So at any point when most of the people who wants to buy have already gone in, that is where you're at the market top, right? And if you continue to just chase after the price, the share price, the moment it comes down, and if you don't even understand why you're buying it, these are the people who usually have weak hands. So they'll be the first to sell off because they are just
Yeah,
following. There are a
correct.
lot of people, they just follow their friends. I follow what I see on social media, but they don't really understand what they're buying. So they are just buying in because the share price keeps going up. So in the end, when the price turns, they are the ones that are going to have weak hands, sell off, and you're going to lose money. So I think it's important not to just chase blindly, but to really understand what you are buying into, and that's how you can actually protect yourself as an investor. Yeah.
Yes, I agree. And I actually think that the feeling of FOMO is actually good for investor. Okay, the reason why I'm saying that is that if FOMO can make you study the company faster and better, and you quickly study them and understand the reason why you want to own them.
Okay.
So it's not wrong to actually buy something at a higher price as long as you can justify that the fair
Okay.
value is much higher than the current trading price
Yeah.
itself.
So in
Yeah.
other words, you can be FOMO. I mean, human beings, we
Yeah.
all have
Yes.
emotions, right? But you need to use it in the right way lah.
Yes.
Yeah, you don't use that in the wrong way. You manage your investment wrongly, then yeah, that is where we'll start to lose money.
Correct.
Yeah, and the opportunity cost as well. Okay, so on top of that, Anshul, do you have any burning questions or topics that you want to talk about and discuss today on this
Right.
topic of
I
interest
think,
rate?
many of the retail investors always believe that US dollar is the powerful currency that you should always hold on to. And with this fact cut, maybe these retail investors are already holding US dollar. So how can they salvage the situation?
Okay, it's super difficult to
Mhm.
predict the movement of a currency.
Correct.
And then I am super bad on that. So I cannot give you a predictions of how good will the currency appreciate or not.
Right.
But I do say that the underneath theory here is whenever the economy is growing stronger, the currency should stay strong or appreciate. So it's of your will whether you believe that US economy will grow stronger. To me, 100%.
Okay.
So this is why I don't think that you should salvage the currency situations as long as you are staying invested in that asset long enough. The currency should revert to the mean.
Right.
Okay, and I do say that probably if you think that a country currency is depreciating, then you should not invest in that country in the first place.
Wow.
Yes.
Wise words, I guess.
Whether you still believe in whether the companies in that country are still going to be strong, they are still going to be the leaders, they're still going to be doing well. Yeah, I mean, it's I don't know, fortunate or unfortunate that we have a very strong SGD here.
Yes.
Yeah, so that's why when you compare against many countries, right, that is something that
Yep.
people, they have this concern, this headache about. But at the end of the day, if you're actually able to make more out of those investments than the currency depreciation, then you are still a net winner from that aspect.
Yes.
Yeah. Other than this, any other things?
Maybe James, could you share with us, right, that like in the event that a US Fed price drops, then indirectly the companies find this opportunity to grow their business because it's cheaper for borrowing. Then in that sense, companies in Singapore would also expand in this manner, and then will you say that the growth or the GDP will increase for Singapore, which would then indirectly impact the inflation? And apart from not putting our money or not having majority of our funds in the bank, how can we then salvage the situation to improve or hedge against inflation because of the recent 6 to 12 months Fed price drop?
It's complicated. it's a tough question. But probably we just keep it simple.
Sure.
So whenever Fed cut the interest rate,
Yep.
it should benefit the stock market and should benefit the corporate earnings, should benefit the economy growth as well. So if we just keep it simple and Singapore being a trade-oriented economy,
Yep.
so as long as US and China doesn't go into recessions, so we should not go into recession as well.
Okay.
So in general, Federal Reserve cutting interest rate should benefit us in terms of the economy and the stock markets.
Okay, sure.
And I think one good thing is we have a very supportive government as well.
Yeah.
So we
Right.
have a lot of those stimulus that they are always ready to bring it in to support the economy here in Singapore. Yeah.
Yes.
So before we end off today's conversation, right? So Anshul, what is one thing that after this, one action that you would take to manage your portfolio? Maybe it could be 5 years down the road, 10 years down the road, but you think that is something that would really be helping you even when interest rates are changing, even when in the future we have recession, inflation, and the different macro environment changes.
Maybe I'll take James' advice today. Buy
Okay.
high and sell higher.
Yes. It's a wisdom.
Use of wisdom.
Yes.
Okay.
Yeah.
Yeah. So, and for James, if let's say you could speak to your younger self, what is one advice that you would give to your younger self on how to manage your portfolio with all these changes in the macro environment?
I would say that I'm still young, so I do not need to speak to my younger self. I can speak to myself right now.
Okay.
Okay. So if I were to speak to myself
Sure.
right now, I would say that don't worry too much about the interest rate. Okay, I would say that interest rate is only one of the thing that could impact your portfolio. As long as the Federal Reserve is cutting interest rate, just to keep it simple, stock market should benefit. And that's
Okay.
it.
Right. So really thank you to
Yes.
James and Anshul for joining me today in today's discussion on the topic of interest rate changes. I think it's a very timely topic that a lot of audiences will want to find out more during this period of time, how to manage their portfolio better. Yeah. So the next time when you see a Fed rate cut or rate hike that's trending, don't just react immediately. Take a pause first and understand what it really means to you so that you can stay ahead of the market noises. So until next time, keep your FOMO in check, stay informed and happy investing. And we will see you again in the next episode. Thank you.
Thank you.
Thank you for today.
Thank you.
If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.